Hello, everyone. Welcome back. I'm just going to encourage you all to take a seat as soon as possible because we have a very packed session before lunchtime. We have a wonderful keynote speech coming up with Kyriakos Pierakakis from your group, and then we have a panel discussion on digital finance, cryptos, and the Savings and Investment Union that's been mentioned many times over the last day and a half. And then we have a keynote speech and a Q&A with Arthur Mensch from Mistral AI. So please take a seat as soon as possible. We really want to start on time. So again, I can see the doors are still open. You have 1 minute to come and sit down, and then we will close the doors and we will start on time for everybody involved in the keynote speeches and the upcoming panel. Welcome back, everybody. Thank you so much for being in the room. And we have a really wonderful set of speakers coming up in this section. So we're going to invite, first of all, and it's a great honor to have Kyriakos Priakakis, President of Eurogroup and Minister of Economy and Finance of the Hellenic Republic. So thank you very much for coming to Luxembourg and delivering this keynote speech. And following that, we will have a panel discussion, also with wonderful speakers, on digital finance, cryptos, and the Savings and Investment Union. But first of all, please welcome to the stage President Priakakis.
Thank you so much, ladies and gentlemen, President Calveño, dear Nadia, distinguished guests. It's a pleasure to join you today at the European Investment Bank Forum, a cornerstone of Europe's investment capacity and a symbol of our ability to transform common ambition into concrete projects, exactly what the remit, the scope, the mission of the EIB is. We meet at a moment when developments in the Middle East have escalated markedly, with repercussions now reaching even Europe's shores. What is unfolding amounts to an unprecedented and deeply concerning crisis, placing significant strain on an already fragile international order. At a time when geopolitical shocks are multiplying, our economies have no room for complacency. For Europe, the stakes are both economic and strategic. This is a matter of strength, a matter of autonomy, and a matter of resilience. The Middle East lies at the heart of global energy flows and critical trade corridors. When instability reaches this core, the consequences are immediate and the consequences are measurable. Energy prices rise, transportation and insurance costs increase. Of course, the full scale of the impact will be a function of the duration of this crisis. It will largely depend on it. That is where the real effects on shipping, supply chains, and investor confidence will become evident. The longer uncertainty persists, the wider the economic footprint of the crisis will be. But to be frank, the era of geopolitical innocence is over. Europe's sovereignty is no longer an abstract ambition. It is a condition for economic survival and institutional strength. It is our capacity to absorb external shocks, to safeguard our energy security, to protect our productive base and capacity build it, and to act early, collectively, and decisively. What is required now is a clear sense of urgency, with the full understanding that in times of crisis, time is never a neutral variable. Europe possesses the tools to shape events and to reaffirm its strategic power. The EIB is a preeminent tool amongst those tools. We must move swiftly and in coordination in order to ensure that it does. Europe has proven its resilience in many occasions in the past. We have absorbed financial turmoil, sovereign debt stress, a pandemic, and an energy shock. We protected our societies when it was needed to do so. We stabilized our economies. We acted together when it mattered the most. But resilience is not a growth strategy. Today, Europe faces a structural competitiveness problem. Productivity growth has lagged for too long, and the gap with the United States has widened over 2 decades, while at the same time, demographic headwinds are becoming significant economic constraints. By 2040, Europe's workforce could shrink by close to 2 million people per year. And this is evident, I would say, in most member states of the European Union. It's certainly evident in Greece, where I come from. That matters because it changes the equation significantly. Growth can no longer rely on expanding labor supply in the same manner that it did in the previous decades. It must come from higher productivity. And higher productivity comes from innovation, from investment, and from efficient capital allocations. Put it simply, the growth model that supported European prosperity for decades has reached its limits. So the strategic task in front of us is quite clear. We must mobilize capital more efficiently, more effectively, in order to finance innovation, in order to achieve scale. That is the only lever that can raise productivity at the time frame that we wanted to, increase incomes, strengthen strategic autonomy, and build resilience, further build resilience. Europe does not suffer from a lack of savings, as we often discuss in the context of the whole project called the Savings and Investment Union. We suffer from a lack of mobilization of those savings and vis-à-vis how to channel them into strategic investments. Every year, Europeans save roughly 1.4 trillion euros, and too much of it remains in low-yield deposits. Meanwhile, our competitors invest more heavily in frontier technologies and manage to scale faster. You can see this in the numbers. R&D intensity in the EU is around 2.2% of GDP, compared with roughly 3.4% in the United States. Venture capital investment is roughly 0.3% of GDP in Europe, compared with around 0.7% in the United States. And those are not really abstract statistics. They translate into whether companies can grow, they translate into whether ideas can scale, and whether Europe sets standards or adopts them. Are you a standard setter or a standard taker? The gap is not accidental, it's not coincidental, it reflects structural features of the financial system, a stronger reliance on bank-based intermediation, fragmented capital markets, and a risk culture that too often favors preservation over scale. So there's the core diagnosis, I would say. Europe does not lack ideas. It does not lack talent. It does not lack savings. What it lacks is the scale and the channels, the mechanisms, to turn savings into investments, into innovation. That is why the Savings and Investment Union matters so much. This is why we codified it as the core project that can be delivered in the coming years. It is the structural reform that Europe has postponed for too long. But it is also why we must now speak seriously about the next layer, modernizing the infrastructure through which capital moves, through which capital flows. This is where the EIB Group is absolutely essential. The EIB and the EIF are not only lenders, they are builders of European capacity. They de-risk investment where markets hesitate. They bring projects to bankability. They create standards. They help Europe crowd in private capital. In other words, the EIB Group is one of the few institutions with the mandate and the credibility to bridge Europe's savings with Europe's need for scale. If Europe wants to compete, and it does so, we need more projects that are investable, more markets that are investable, and more pathways for private capital to follow public de-risking. This is not a slogan, and it shouldn't be just a slogan. This is the practical mechanics of competitiveness. And it is why the theme of this forum, strengthening competitiveness and security, is not only timely. I would say that it is absolutely unavoidable. That brings me to the focus of my remarks, digital finance. Digital finance is not a marginal upgrade to our financial system. It is a structural transformation vis-à-vis how capital is raised, allocated, settled, and supervised. The transformation will happen with us or without us. The real question is whether Europe shapes it or whether Europe adapts to it, to frameworks that are actually created elsewhere. If we get it right, digital finance can do something profoundly important for Europe. It can compress distance. It can compress the distance between savers and innovators. It can compress the distance between small firms and deep pools of capital. It can compress the distance between national markets and the genuinely European market. Distributed ledger technologies, DLTs, can reduce frictions in clearing and settlement, lower issuance and intermediation costs, accelerate cross-border payments, and expand access to investment. Tokenization can reduce issuance costs, particularly for SMEs, and connect companies to wider investor bases across Europe. The point, I would say, and also not only wearing my finance minister hat, but my previous digital transformation minister hat, is that technology is not about technology. You don't do technological change for its own sake. The point is how it can mobilize and solve societal needs. In the specific case, how it can lower structural cost of capital in Europe and whether we can allocate capital faster and more efficiently to productive investment. The rewards are real: greater innovation, greater inclusion, more competition, lower costs for innovators, deeper pools of finance for entrepreneurs, more transparency for investors. But this can happen only if we embed this within the broader European institutional framework. Digital finance cannot substitute for structural integration. It can only complement it. It must complement it. The Savings and Investment Union deepens and integrates capital markets across Europe. Digital finance modernizes the infrastructure that allows those markets to function efficiently and at scale. Integration without modern infrastructure will be slower, will be more expensive, will be less competitive. Modern infrastructure without integration will remain fragmented and small. So you need both. So I would say that those are actually not two parallel agendas. It is one broader strategic project. Integration and modernization advancing hand in hand, advancing together. This is how we mobilize Europe's savings more efficiently. This is how we fund innovation at scale, and this is how we build the European capacity that our competitiveness and security now largely depend upon. But where there is promise, there is always risk as well. And Europe has learned this lesson before. Financial innovation delivers efficiency, but also requires further coordinated supervision and robust governance if we want trust and stability to travel with it. So we must be clear about the risks we have to manage while we're also unleashing the innovation that is absolutely essential. First, the first risk is fragmentation. We cannot allow digital innovation to fracture our markets into national silos. We cannot allow platform ecosystems to grow into new forms of market separatism. Second, volatility and instability. Crypto assets and stable coins have shown how quickly innovation can outpace oversight. Cyber risk is not a side issue in this regard. I would say that this is absolutely systemic. The lesson, in my view, here is straightforward. Innovation without trust does not really scale. And trust is not created by optimism. It's created by rules, supervision, credible enforcement. Europe has already taken an important step with MiCA. It has demonstrated that smart regulation can build trust, and trust can then enable scale. At the same time, preserving trust and stability in an increasingly digital financial ecosystem remains essential. And in this context, the digital euro is a key strategic initiative. As President Lagarde has argued, it is about ensuring that central bank money remains available in the digital age, complementing cash, supporting innovation in payments, strengthening Europe's monetary sovereignty, and reinforcing the resilience and the autonomy of European payment systems. I would say that this is the core project with regards to capacity building, to further capacity building the international role of the euro. We're now moving beyond the preparation phase and into the next stage of technical work in this regard, and the time frame is already set for the adoption of the digital euro for the coming years. But in reality, if there's one key point to make here, is that Europe must not outsource the foundations of its payments architecture. It must actually create a very strong public infrastructure and then allow for private innovation to take place around this public infrastructure at the same time. There is also a geopolitical dimension here. In an era defined by technological rivalry and strategic competition, financial infrastructure is an instrument of sovereignty. The question is not whether digital finance will grow. The question is whether it strengthens Europe's autonomy and stability, or whether it creates new dependencies. And I think this is quite critical to understand, both vis-à-vis digital finance, but also with regards to any other digital innovation, be that the cloud infrastructure, telecom infrastructure. Do you capacity build, or do you create new dependencies? And to which regard you allow for A or B to manifest itself? I would say that in this regard, we must ensure that digital innovation fortifies rather than weakens the integrity and the resilience of our systems. This means strengthening, in this regard, in this specific project, monetary independence. It means ensuring secure rails for payments and settlement. It means rules that protect stability and consumers while enabling markets to scale. The choice here is not between innovation and stability, in reality. It's not a trade-off. The real question is whether we have the strategic clarity and the political confidence to go with it, to achieve both at the same time. Let me end with what, in my view, success would look like in this regard. Success is a Europe where savings does not sit idle while innovators search for capital. Success is a Europe where a company can scale across borders as easily as it scales within a single member state. Success is a Europe where technology lowers costs and expands opportunity without undermining stability. Success is a Europe where capital markets do what they're meant to do, allocate capital efficiently to productive growth. If we get it right, if we get this right, digital finance will be a catalyst. It will deepen capital markets, enable seamless cross-border investment, and further fund innovation at scale. And institutions like the EIB Group will remain central, will be absolutely essential in this equation, not only as financiers, but as builders of European capacity, accelerators of investment, and anchors of trust. Trust is the direction Europe must now choose, not simply to manage stability, but to build the foundations of the next wave of prosperity. Thank you very much.